Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, September 30, 2014, and we closed September, we closed the quarter, and the market's still headed down. So you're looking at a weekly chart of the SPY because I want to show you where I'm getting some of the support levels from and what we should be looking for going forward, because there's some action coming up, and it makes sense for you to see this, and you'll understand it as I explain it. So I used the weekly chart on this because it was easier to get the bigger picture from the bigger time frame. So I just wanted to show you, and by the way, when we draw in trend lines as analysts, we don't draw in the trend lines. The charts draw the trend lines. We just follow them. So I'm not just picking an arbitrary number. I'm picking an arbitrary spot on the chart. This goes back to November of 2012, where this purple line begins. And if I take it all the way through to the first pivot low and all the way through, you'll see you came close here, you hit it here, you came close here, kind of close here, and here we are again. And that's the reason I wanted to draw this line in, because it makes all the sense in the world that we would bounce off this line or maybe pierce it by a little bit, but I don't even think we will. This line, since November of 2012, has proved important. It's going to remain important until it's broken, therefore until it's not. So here's the point. Where is this line coincide with where we are now? In other words, where is this line from a number perspective? Well, I'll pinpoint it the best I can. Now, I have the number because I did the calculation. So it's not only, charts, it's also mathematics involved. And my calculation comes to, really, I don't want to pinpoint it to the penny. That's a fool's game. So I always use a spread, and it's going to be between 194.5 and 195. That's where this line comes. Now, keep in mind, this is a weekly chart. So if we flip over to the daily chart, and let's see where that takes us, okay? All right, so now we get a kind of a better close-up view of where that is. So 194.5 to 195 is right in this area here, okay? See this pivot low right here? Okay, what is that? 194.28, 194.30. Okay, well, let's get the exact number. The low was 194.31, okay? So it makes sense that this is a stopping point when you see the line from the weekly chart, this pivot low, and the fact that we've been selling off for minus a couple of up days, but the market's really been in a downtrend for 1, 2, 3, 4, 5, 6, 7, 8 days. Okay, maybe another day or two, but that'll make 2 weeks of downtrend, and it's probably due for a bounce. There's a lot of stocks that are coming into very, very important support levels just like these, okay? And when you see that, you would expect the stocks to bounce and you would expect the market to bounce, and therefore that's what I'm looking for. Now, could we go lower than that? Sure, we can go lower than that. Remember, okay, on the daily chart, okay, we could come all the way down here and by the end of the week bounce back up to 195, let's say, and that would still be inside that line from the weekly chart over here, okay? So this is a weekly close. Now, you've never pierced this line from this November low here, November 2012. Okay, so that's almost 2 years of this trend. That's why this line is important, okay? So what you should be looking for is you should be looking for a bounce off this line. So if you're looking to play the market long, you're looking to play the market long when the SPY gets to about 195 to 194.5. It's that simple. Don't overthink it. That's the number. Forget what they're saying in the news. Forget the headlines. Forget everything. You just buy the market at that level and you put a stop. You give yourself maybe 50 cents in the SPY or the equivalent of whatever you're trading. That would be about 5 points in the the S&P 500. You use your common sense, because if we break this low and close below this low on a weekly basis, then these come into play, and that's why I drew them in. So your first level here is about 180. You just call it 188.50. Then you have a 184.5 to 185, and you have a 181. Okay, 181 to 181.5. All right. So these levels come from these pivot highs. Okay, and they're important. Here's a pivot high matched up with a pivot high matched up with a pivot low. I'm telling you, this level is important on a weekly closing basis. Absolutely important. Okay, same thing for this. Pivot high matched up with pivot lows. The market told you that these levels were important. They were important before. They'll be important again. Same thing. Pivot high. Okay, not quite a pivot low, but this level is important. I'm telling you it's important because the market told us it's already important. All right. That should give you a pretty good picture of the short-term forecast for the S&P. Let's go over and take a look at the IWM because I mistyped that. Talking and typing. Okay. This is the weekly. Let's go to the daily chart of the IWM, and you'll see how weak this index is. Look at this index. It's just been in a trend, downtrend, relentless. Look at this crossover coming. This is trouble, right? You're going to get some support at you already had it at 110. You broke it today. Next level of support is going to be 108. Okay, right down here. Okay, this pivot low here. Maybe as low as 107.5, this double bottom here. Okay, let's just go back a little bit. All right, so 107.5 to 108. That's your next level of support. If you break that level of support, all right, let me zoom this out and go to the weekly chart and show you. See, that's this level here, 107.5 to 108. Okay, there's a lot of support in here, tons of support. You should not break this level, certainly not in one day. Just like you didn't break the 110. Watch this. Okay, the 110, you kind of bounced around it for a few days. Okay, so an important level, the market's going to fight that level. So it's going to fight 108, 107.5, 108. Next level would be 102 to 103. 100. I mean, you just have these levels is way down here. So, first we got to get through one to get to another. So we're just going to leave it at that. But I just wanted to point out that this is a quite the bearish index. Now watch this. Okay. Well, I drew it in the wrong place. Let's see if I can move it. Again with that. Here. Let's move this line up. Okay. All right, it's not doing it. What I wanted to show you is that this could be a weekly head and shoulders pattern. And if it's a weekly head and shoulders pattern, okay, see you have a left shoulder, you have a head, which this is higher, and you have a right shoulder, and you're breaking this now. Okay, if you break this and close the week below this level, okay, your target from here down is another 10 points. That's $100. Look at this pivot right here. Okay, that's your target if this head and shoulders plays out, if this closes the week below. Okay, we'll see. It's not the most perfect pattern, but it certainly has the makings of the pattern. So we'll see what happens. I mean, that's just from an eyeballs view, that's what I see. All right, let's go to gold real quick. Gold had another down day, and I've been talking about this double bottom for a while. Gold did bounce up a little bit, and then it sold off. I still think we get a bounce up to the at least the 1230, hopefully the 1250 area. But it looks like we're going to come into this double bottom first. We might even pierce it, and then they'll fool everybody, take out some stops, and rally the market back up. If you're not interested in sticking around for that, then don't, because after that bounce, I think there's a lot more downside to gold coming. So we'll see how that plays out. We have to see how they react off that bounce. But every which way I calculate the numbers, I look at it 4 different ways, and all 4 ways point to the same thing, down. So I'm just doing what the chart tells me to do. Oil had just an absolute all-out shellacking today. All of a sudden, in the middle of the day, oil decided to sell off, and the price of crude went down. I'm looking on my other chart here. The price of crude went down over $3 today to 91.20 or something like that. It's up. It's already up in the aftermarket in the new session, the Globex market. So I can't get the reading on yesterday. Well, yeah, I can. Hold on a second. I'm going to get you the number. It was. It went from a high of 94.90 to a low of 90.86 all in one day. Look at that move. Holy cow. That tells you there's more downside coming. I've been telling you the mid 80s in the price of crude, which puts the USO down at least another $1 from here, probably a little more. And there's just more downside coming in the price of oil. So, these are all deflationary signs. Gold going down is deflationary. Oil going down is deflationary. The market going down is deflationary. So you have to be careful. However, we're going to get some bounces. They're going to be sharp. They're going to last from days to weeks, depending on where we are in the market. And when that happens, everything's going to seem fine again. It's going to seem like it's a bull market again and all that stuff. So you just have to be careful. We'll just play it one day at a time, and we'll see what the charts tell us what to do, and we'll act accordingly. So whatever the pattern, the chart patterns tell us what to do, is how we're going to react to what the market tells us. I'm going to leave it there tonight, folks. This is David Frost, mystrategicforecast.com. This was another episode of Common Sense Market Analysis.